This is video 3 of Matilda Limited, combining debentures of IFRS 9 with IAS 8. Let's have a look at what should have been done. Well, what should have been done is that the transaction costs should have changed the initial measurement of the liability. And because it is a liability, if you look at the journal entries of what should have been done, there's a debit to the debenture liability because of the transaction costs, which means that your initial measurement amount of the liability is fair value less the transaction cost. It reduces the initial measurement. Because of that, because PV or fair value on day one changes, you need to go and calculate a new effective interest rate. Now, in our example, the debenture matures once off, so we can use the normal functions on your calculator: N, payment, FV, PV, and in this case, we want the new interest rate. So it's a 5-year term. The payment is what flows in cash every year. That is the cash flow interest. Nominal value times nominal rate. The future value is your maturity payment. Future value refers to a once-off payment at the end of the term of the instrument. So that future value is at a premium of 10%. They told us the debentures mature at a premium of 10%. So there are 10 debentures. The nominal value per debenture is 5,000 Rand and they mature at 10%. So times 110 or add 10% onto that. Your PV is your initial measurement. That would now be your fair value that they gave you in the question, reduced by the transaction cost, because that's what the journal does. If you look at your journal entry, it's a debit to a liability. It makes the liability less. And you calculate your new effective interest rate. What do I do with that new effective interest rate? Well, you calculate the finance cost in each year. So if we have a look at the interest journals at the end of 30 September 2014, the journal entry debit finance cost, credit debenture liability, that was correct. They did do that, but the amount is wrong because we start with balance on the T account. That balance has changed with the transaction cost, and you multiply it with your new effective interest rate. So the finance cost amount is different from what was done. The cash flow stays the same: credit, bank, debit, debenture liability, nominal value times nominal rate. The balance on the debenture liability at the end of year 1 is the amortized cost of the liability. You are in the category at amortized cost. That balance is amortized cost. The fact that you add interest on, then deduct the payment, the fact that you would deduct any maturity payment, that is amortized cost, that balance. If we then have a look at 30 September 2015, we have to do the interest journals. The first journal is debit the finance cost, credit the liability. How do we calculate that? Balance on the debenture T account at this moment, the balance that accrued interest for this period, times the new effective interest rate that you had to go and calculate because of the transaction costs changing your PV. The second journal is the actual cash flow journal. It will stay the same: nominal value times nominal rate. No nominal value has been repaid or matured. It's the full nominal value that's still outstanding, and you calculate the balance at the end of 2015. That balance is the amortized cost of the liability. If we then compare what was done, that was given to us in the question, to what should have been done, that we have just looked at in our calculations, we can see that at the end of 2014, what was done would have given us a debenture liability balance of 48,500 577. How do we get that? We just look at all the journal entries that were done that affect the liability, take them all into account, and look at the new balance at the end of 2014. What should have been done would have actually given you a balance of 46,403. How do we calculate that? We look at all the journal entries that should have been done and that affect the liability. That means the liability should actually decrease. It was 48 something, it should be 46 something. There is a decrease. In this case, the debenture liability will only be non-current because there is no repayment within the next 12 months. The debenture only matures once off and only at the end of a 5-year period. So at the end of 2014, there's nothing in the balance that will be repaid within the next year. So the entire balance is non-current, long-term. What else? What other differences are there? Well, the other expenses, there was 2,500 transaction costs. There should be nothing. So other expenses in 2014 should decrease. There should not be other expenses. What else should be different? The finance cost of 2014, that expense, the interest expense, was calculated as the balance times the market-related rate. The balance was wrong and the market-related rate should have been calculated differently. So where we had finance cost of 7,119, we should have had finance cost of 7,445, which means there's an increase of 326 Rand. If we then have a look at profit or loss in total, profit or loss in total is the transaction cost, the other expenses that should no longer be there, together with the finance cost that should be different. Now, this is for 2014. What about 2015? Well, 2015 is our current year. If you realize you made a mistake in the current year, the year you are still busy with, still working on the financial statements, just fix it. The standard IAS 8 is about prior period errors. So any error that happens while you are busy with the current year, you don't need to tell your users, oh, you know what, while I was busy with the financial statements, I made a mistake, then I saw it, then I fixed it. That's not what IAS 8 is for. IAS 8 is about financial statements that were already issued, that had a mistake in, where we go retrospective to prior years, fix the mistake retrospectively. So we issue financial statements for 2015, but our comparative year, the 2014 year, all of a sudden is different from what it was when I issued the 2014 financial statements. Now I need to tell my users, why is it different? Why are the financial statements changed? What happened and which line items were affected?